So this means that we are actually overspending, all right, our insurance that doesn't even meet our needs, right? Means we are paying a lot of money and we are not getting enough cover. Hi everyone, I'm Mike from Haven. I'm lead insurance specialist. Today I'm going to share with you about how much life insurance do we really need. So this has been a question where I think most fresh grad or even mid-career change, sometimes they may not understand how much life insurance do they really need and if they are sufficiently covered. So today the key things is we will bring everyone through of how we can be sufficiently covered. Right. So the key learning point for today will be more of the basic financial planning guides, which has been recently launched by MAS and also together with a few financial agencies. All right, and they actually come up with this thing called the rule of thumb. All right, essentially compare it with our method, which is Haven approach, uses capital and income needs approach, or you can name it as a CINA. What is the kind of the differences between our method and also the rule of thumb methods. All right, and lastly, we're going to share more about the repercussion of when we are under or overinsured. All right, so how much do we really need it? Okay, so in October 2023, MAS together with the rest of the 3 financial agencies actually help Singaporeans by launching this thing called a basic financial planning guide, which come out a rule of thumb, where it's actually outlined to say how much we need to save as a Singaporean per month, and how much our insurance we should spend on, and how much coverage we need, as well as how much investment we should actually approach, how many percent of our income we need to be set aside. And in June and January 2024, all right, they actually advances it. Basically, they expand in terms of their planning guide because they know that different adult Singaporeans or even PRs, right, they have different stage of life and there's no such thing as a one-size-fits-all. So they actually expanded, like for example, a scenario of a fresh grad, what kind of insurance they need and how much savings they should save, and even investment as well. So there's a 4 category. So fresh grad, working adult with young children, working adult supporting aged parents, and even pre-retirees. And because they launched this scenario-based and planning guide, it becomes more targeted and be more relevant towards each category of Singaporeans of life stage that they are in actually. So it gives them like a very good starting point that they can plan their finances. So when we come to rule of thumb, especially for today's session, it's really about insurance protections. So by using the rule of thumb, it's actually to help us to determine our insurance needs, all right, and also to find out whether are we overinsured or underinsured. All right, so by looking at this thing, rule of thumb, so just the protection itself, so to obtain insurance protection, their calculation will be death and total permanent disability is to cover 9 times of annual income, all right, and also critical illness to cover 4 years of annual income, all right, as well as for be familiarized with the national schemes such as the MediShield Life that cover large medical bills, as well as the long-term care and our CareShield Life ElderShield, all right, which is to cover us in terms of severe disability. And overall, their rule of thumb will be to spend at most 15% of the income for all these insurance protections, all right. And they even come up with to consider, what to do is to consider term insurance plan, which are actually affordable for protection. And of course, if we are age 55 and above, of course, we need to ensure that we review our insurance regularly, 2 to 3 years, to ensure that the premium still remains affordable to all of us. Let's look at the scenario for using the rule of thumb. For example, in Peter's situations, all right, let's say that Peter is sole breadwinner in the family. He's a working professional, earning about 100,000 per year. Right, he has 2 young children as well. In terms of insurance plan, he has about 500,000 in death cover. All right, 100,000 in critical illness coverage. All right, so by using the rule of thumb, we can very quickly determine how much insurance we need for coverage and whether if we have any gaps or surplus. So under this table, if we are using the rule of thumb, all right, death and disability will be about 9 times, critical illness 4 times. So if we look at the coverage required for Peter, all right, he will need about 900,000, all right, for death and total and permanent disability coverage. In terms of critical illness wise, will be about 400,000, all right. But based on his current coverage alone, all right, he actually has 500,000 for death and total permanent disability. All right, for critical illness wise, it's about 100,000. So all in all, there's a shortfall, I would say. All right, and the shortfall will be 400,000 in death and disability coverage, 300,000 in critical illness coverage. So next we'll be using Haven's approach, which is our capital, income, and needs approach. All right, it's slightly different from the rule of thumb. So basically what we find that because everyone's financial situation is different and very unique, and in fact everyone's financial goals is different, right? So because everything's so different, right, we basically customize the planning towards individual needs. All right, so basically Haven, we use CINA to actually determine how much one person really need for the insurance. All right, for example, let's use back Peter's insurance gaps again by using this CINA method and his financial information, and we're going to do a calculation as well. So let's proceed to the next scenario. All right, so for scenario 2, it's really to calculate the death and the disability needs. So using this income, capital income needs approach, so firstly we need to understand what is Peter's existing assets. For example, the CPF, the total CPF amount that he has, the savings, the investments, property as well. Liabilities, whether Peters do have any mortgage liability, car loans, etc. And of course, financial obligation. For example, in the event of early demise, how much money he requires to so-called to actually help the family to tide through the years when the young children actually be independent, which means that they finish their tertiary education and to go out to the world and work. And of course, using this method, we can actually help our client to better see their current financial position so that they understand what they have, and also to be more clearer to understand the whole entire of his insurance planning. So let's look at the example for this table. Let's assume that for Peter, he has a total assets of about 500,000, which includes savings and even CPF and even some investment, right? And the insurance that he has for death cover was 500,000. So in terms of total estate available, right, it will be a positive 1 million. All right. So next, let's look at liability and financial obligation. So if we look at the mortgage liability and vehicle loans, assuming that he has about 850,000, right? And assuming that in the case of early demise, to replace the family income, assuming because he's a sole breadwinner, right? So if he's no longer around, someone need to go out and work. It could be the spouse or even the children have to, step out a little bit. Yeah, going out and work when reaches a working age, like 18 years old, right? So to continue allowing the family to maintain that lifestyle is 50,000. He dreams to have 50,000 for the next 20 years, all right? So in that sense, financial obligation will be 1 million. So in terms of child education, all right, in Haven, we actually do research in terms of university, in local and even overseas. Okay, so assuming that both children are going to study in local U, right, the total amount required will be close to about 200,000. All right. Of course, final expenses, for example, legal, probates, and even funeral, all these things, it costs about 30,000. All right. And the total required is actually 2,072,000. So if we look at the total estate available and the total required, so he actually has a insurance shortfall about 1,072,000 in total. So with using our method, we can see that there's a disparity, there's a difference that Peter, who used the rule of thumb, and also using our method of calculations, all right? But of course, that's saying that everyone's financial situation is different, so not everyone is the same, all right? So for this particular example, we are using Peter's example. With this calculation, we can very assure that he has this additional $1 million of death and total permanent disability needs. All right, so next topic, let me bring everyone through is the repercussions of being under or even over-insured. All right, basically there's 4 scenarios. So let's go through the first 2. All right, the first 2, let's go through the underinsured. All right, assuming that today we are underinsured, right? What will happen to the whole entire family? All right, the family typically will lack of financial support. You know, someone have to go work. Reduce lifestyle. For example, the family needs about $5,000 to survive every month. And in the event early premature death, all right, the family will basically loses that amount of money to sustain their lifestyle. And in that sense, everyone basically, someone had to go out and work to earn a living so that to support the entire family expenses and lifestyles, all right. Next will be difficulties in funding tertiary education, which means that both children may have loses the opportunities to actually enter university to so-called to have further their studies. Okay. Next will be underinsured but overpaying premium. All right. So this means that we are actually overspending. All right, our insurance that doesn't even meet our needs. Right. It means we are paying a lot of money and we are not getting enough cover. All right. So this is something that is that we meet. Sometimes we meet with our client, we find that, oh, they are paying a lot of a high premium. And in fact, some of them may spend even beyond 15% of their money income to get covered, to realize that their coverage is actually not enough to meet their needs, all right? And of course, next one will be overinsured, all right? Which means we are spending too much of our insurance premium. And the thing is, we are over-insured, means we are covering more than what we need, all right? So in fact, since we are paying more, means we have lesser financial resources to actually save for the future, all right? For example, our financial goals or even retirement. And of course, when we are over-insured, means we are overpaying something, right? And this is not something that we can, we may not be able to enjoy certain lifestyle. For example, going to movie, going to gathering with friends. Maybe we have to cut, you know, this kind of entertainment or lifestyles. And sometimes even over-insured and paying high premium, this is the worst because the thing is, one may have financial difficulties, right? And meeting daily livings. We are overpaying, means we could be very scared that something will happen to us, and we really keep buying insurance, a lot of insurance, and that resulted that maybe we are paying more than 20% or 25% of our annual income on insurance alone, and this actually will affect our daily living expenses, and hence we may not even have enough money to save for our financial goals, right? Or even other different type of trying out different type of lifestyle. So in conclusion, right? So the rule of thumb guide is actually good for someone who prefer to DIY for their insurance planning. So there's a guide that he can actually follow, all right? And also good for individuals who actually have a starting conversation with their trusted advisor, so they can slowly to understand more about their financial position and also to understand what kind of insurance need they have. And of course, doing insurance review, regular insurance review is a very important thing because this is to ensure that we have a right amount of coverage. And every time there's a change in terms of lifestyle, for example, moving on from a fresh grad, to working adult life, to become married and having young children, and eventually move on to a retiree. All right. So every stage, every life stage have changed. Our financial position will also change, and our need will also change as well. So it's good that we do a regular insurance review. And lastly, based on our Haven's approach in terms of insurance planning, all right, we view insurance as a form of expenses, all right. But of course, these expenses is not something that we should cut short of, but that's a tag that we also always say to buy as much insurance as we need, all right. Because if we want, when we know about the insurance gaps that we need, all right, and of course, the next step is to pay as little as possible so that we can get sufficiently be covered. And lastly, all right, at Haven, we are insurance specialists, and assuming that you need any help, all right, any doubts or any helps, all right, you can actually reach us at haven.com/contact us. Thank you. Lie. So today, I'm going to share a little bit about small.
Behind the line.
Yes.